Approaches to valuation. In general terms, there are three approaches to valuation. The first, discounted cash flow (DCF) valuation, relates the value of an asset to the present value of expected future cash flows on that asset. The second, relative valuation, estimates the value of an asset by looking at the pricing of comparable assets relative to a common variable such as earnings, cash flows, book value, or sales. The third, contingent claim valuation, uses option pricing models to measure the value of assets that share option characteristics. Some of these assets are traded financial assets like warrants, and some of these options are not traded and are based on real assets. The latter are often called real options. There can be significant differences in outcomes depending on which approach is used. Discounted cash flow valuation. While discounted cash flow valuation is only one of the three ways of approaching valuation, and most valuations done in the real world are relative valuations, it is the foundation on which all other valuation approaches are built. To do relative valuation correctly, we need to understand the fundamentals of discounted cash flow valuation. To apply option pricing models to value assets, we often have to begin with a discounted cash flow valuation. This is why so much of this book focuses on discounted cash flow valuation. Anyone who understands its fundamentals will be able to analyze and use the other approaches. Basic for discounted cash flow valuation. This approach has its foundation in the present value rule, where the value of any asset is the present value of expected future cash flows on it. The cash flows will vary from asset to asset: dividends for stocks, coupons, interest, and the face value for bonds, and after-tax cash flows for a real project. The discount rate will be a function of the riskiness of the estimated cash flows, with higher rates for riskier assets and lower rates for safer projects. You can in fact think of discounted cash flow valuation on a continuum. At one end of the spectrum you have the default-free zero-coupon bond, with a guaranteed cash flow in the future. Discounting this cash flow at the riskless rate should yield the value of the bond. A little further up the risk spectrum are corporate bonds, where the cash flows take the form of coupons and there is default risk. These bonds can be valued by discounting the cash flows at an interest rate that reflects the default risk. Moving up the risk ladder, we get to equities, where there are expected cash flows with substantial uncertainty around the expectations. The value here should be the present value of the expected cash flows at a discount rate that reflects the uncertainty. Categorizing discounted cash flow models. There are literally thousands of discounted cash flow models in existence. Investment banks or consulting firms often claim that their valuation models are better or more sophisticated than those used by their contemporaries. Ultimately, however, discounted cash flow models can vary only a couple of dimensions: equity valuation and firm valuation. There are two paths to valuation in a business. The first is to value just the equity stake in the business, while the second is to value the entire business, which includes, besides equity, the other claimholders in the firm: bondholders, preferred stockholders. While both approaches discount expected cash flows, the relevant cash flows and discount rates are different under each. The value of equity is obtained by discounting expected cash flows to equity at the cost of equity. The dividend discount model is a special case of equity valuation, where the value of equity is the present value of expected future dividends. The value of the firm is obtained by discounting expected cash flows to the firm at the weighted average cost of capital, WACC, which is the cost of the different components of financing used by the firm, weighted by their market value proportions. Cost of capital versus APV approaches, we noted that a firm can finance its assets using either equity or debt. What are the effects of using debt on value? On the plus side, the tax deductibility of interest expenses provides a tax subsidy or benefit to the firm, which increases with the tax rate faced by the firm on its income. On the minus side, debt does increase the likelihood that the firm will default on its commitments and be forced into bankruptcy. The net effect can be positive, neutral, or negative. The cash flows discounted are pre-debt cash flows and do not include any of the tax benefits of debt, since that would be double counting. In a variation, called the adjusted present value (APV) approach, we separate the effects on value of debt financing from the value of the assets of a business. Thus, we start by valuing the business as if it were all equity funded and assess the effect of debt separately. By first valuing the tax benefits from the debt and then subtracting out the expected bankruptcy costs. While the two approaches take different tacks to evaluating the value added or destroyed by debt, they will provide the same estimate of value if we are consistent in our assumptions about cash flows and risk. Total cash flow versus excess cash flow models. The conventional discounted cash flow model values an asset by estimating the present value of all cash flows generated by that asset at the appropriate discount rate. In excess return and excess cash flow models, only cash flows earned in excess of the required return are viewed as value creating. And the present value of these excess cash flows can be added to the amount invested in the asset to estimate its value. Note that the answers in the two approaches are equivalent. Why, then, would we want to use an excess return model? By focusing on excess returns, this model brings home the point that it is not earnings per se that create value, but earnings in excess of a required return. In relative valuation, the value of an asset is derived from the pricing of comparable assets, standardized using a common variable such as earnings, cash flows, book value, or revenues. One illustration of this approach is the use of an industry average price-earnings ratio to value a firm. The assumption being that the other firms in the industry are comparable to the firm being valued and that the market, on average, prices these firms correctly. Another multiple in wide use is the price-book value ratio, with firms selling at a discount on book value relative to comparable firms being considered undervalued. Revenue multiple are also used to value firms, with the average price-sales ratios of firms with similar characteristics being used for comparison. While these three multiples are among the most widely used, there are others that also play a role in analysis: EV to EBITDA, EV to invested capital, and market value to replacement value, Tobin's Q. To name a few, underpinnings of relative valuation. Unlike discounted cash flow valuation, which is a search for intrinsic value, relative valuation relies much more on the market being right. In other words, we assume that the market is correct in the way it prices stocks on average, but that it makes errors on the pricing of individual stocks. We also assume that a comparison of multiples will allow us to identify these errors, and that these errors will be corrected over time. The assumption that markets correct their mistakes over time is common to both discounted cash flow and relative valuation, but those who use multiples and comparables to pick stocks argue, with some basis, that errors made in pricing individual stocks in a sector are more noticeable and more likely to be corrected quickly. Basis for approach: a contingent claim or option is a claim that pays off only under certain contingencies, if the value of the underlying asset exceeds a pre-specified value for a call option or is less than a pre-specified value for a put option. Much work has been done in the past 20 years in developing models that value options, and these option pricing models can be used to value any assets that have option-like features. Figure 2.2 illustrates the payoffs on call and put options as a function of the value of the underlying asset. An option can be valued as a function of the following variables: the current value and the variance in value of the underlying asset, the strike price and the time to expiration of the option, and the riskless interest rate. This was first established by Fisher Black and Myron Scholes in 1972 and has been extended and refined subsequently in numerous variants. While the Black-Scholes option pricing model ignores dividends and assumes that options will not be exercised early, it can be modified to allow for both. A discrete time variant, the binomial option pricing model, has also been developed to price options. An asset can be valued as an option if the payoffs are a function of the value of an underlying asset. It can be valued as a call option if when that value exceeds a pre-specified level the asset is worth the difference. It can be valued as a put option if it gains value as the value of the underlying asset drops below a pre-specified level, and if it is worth nothing when the underlying asset's value exceeds that specified level. Underpinnings of contingent claim valuation. The fundamental premise behind the use of option pricing models is that discounted cash flow models tend to understate the value of assets that provide payoffs that are contingent on the occurrence of an event. As a simple example, consider an undeveloped oil reserve belonging to Petrobras. You could value this reserve based on expectations of oil prices in the future. But this estimate would miss the fact that the oil company will develop this reserve only if oil prices go up and will not if oil prices decline. An option pricing model would yield a value that incorporates this right. When we use option pricing models to value assets such as patents and undeveloped natural resource reserves, we are assuming that markets are sophisticated enough to recognize such options and incorporate them into the market price. If the markets do not do so right now, we assume that they will eventually. The payoff to using such models comes about when this correction occurs.